West Texas Intermediate crude oil dictates up to $1 trillion in financial exposure. Accurately forecasting its volatility is a strict matter of corporate survival. For the last 40 years, risk managers relied on the GARCH family of equations. GARCH stands for Generalized Autoregressive Conditional Heteroscedasticity, which is a statistical model used to estimate financial variance. These equations are built entirely on the assumption of volatility persistence, the idea that future market variance is a predictable linear decay of past variance. That assumption failed in the early 2020s. The convergence of a severe demand collapse during the COVID-19 pandemic and the weaponization of global supply quotas broke the linear mechanics of commodity pricing. This chart shows WTI crude oil volatility from 1985 through 2026. For decades, the data operates within a low, predictable baseline of horizontal persistence. Then, 2020 hits. The baseline is torn apart by the extreme vertical outlier, a shock far beyond normal market mechanics. This is a chart showing a baseline model comparison during that exact event. The gray line represents the actual massive spike in volatility. The flatlining blue and green dashed lines represent the GARCH models, demonstrating their catastrophic failure. This proves they could not capture the true magnitude of the shock. Out-of-sample testing evaluates how a model performs on unseen, real-world data rather than its historical training set. Linear autoregression failed because it is mathematically blind to exogenous shocks. A model looking only at past prices cannot process algorithmic news trading or sudden shifts in global narratives. The consensus risk models relied upon by sovereign wealth funds and transportation conglomerates were mathematically incapable of predicting the modern market's most critical threat. To investigate if this event was an anomaly or a permanent shift, we applied the Chow test. The Chow test is a statistical evaluation used to determine whether the relationship between volatility drivers and outcomes remains stable over time, or if a structural break has occurred. The null hypothesis of this test assumes stable time-invariant relationships. It assumes there is no structural break, meaning the market coefficients remain exactly the same before and after a major macroeconomic event. When applied to the WTI market around the year 2020, the test produces an extreme F statistic of 12.84, far exceeding the critical threshold of 1.15, with a p-value of less than 0.01. This result overwhelmingly rejects the null hypothesis. It mathematically confirms a colossal, permanent structural change in the data-generating process of the market itself. Prior to 2020, market variance was a decaying echo of past prices, tightly linked to physical inventory reports. In the aftermath, the market entered an exogenous, narrative-driven state. Today, rapid propagation of global stories and algorithmic news-scraping bots dictate price movements faster than physical supply metrics ever could. The crude oil market transitioned. Any univariate autoregressive model that ignores this phase shift is structurally obsolete. The core flaw in traditional models is assuming that market volatility operates on a single continuous spectrum. The reality is that financial markets exist in discrete, unobservable mathematical states that switch back and forth depending on underlying conditions. Drawing a single line of best fit through two entirely different market states creates an averaging illusion. The resulting coefficients apply to neither reality. The mathematical antidote is Hamilton's Markov switching dynamic regression. This advanced econometric framework freely alternates between distinct, unobserved, discrete market states without forcing an analyst to manually set an arbitrary breakpoint. We define state 0 as the calm regime. In this state, the market is highly persistent, mean reverting, and possesses extremely low variance. We confirm this using forecast error variance decomposition, or FEVD, a method that measures the relative contribution of different shocks over time. During a calm regime, FEVD data shows WTI is roughly 99% self-driven. The market runs purely on long-term price momentum and ignores external policy noise. During periods of macroeconomic peace, the market acts as a closed loop, tricking risk managers into believing their linear models will always hold true. We define state 1 as the crisis regime.
This state triggers when the autoregressive self-dependent structure of the market suddenly collapses. When historical momentum dies, traders search for exogenous anchors. First, physical supply. During a crisis, production's influence on pricing jumps 90 times to 12.8%. Second, policy uncertainty. Fear enters the pricing model, expanding to a massive 25% share. This creates a mathematical multiplier effect. The exact same geopolitical shock is 14 times more powerful in a crisis regime than in a calm regime. Volatility is not self-explaining. It is an entirely shock-amplified, regime-dependent phenomenon. To measure these external shocks, literature often uses the Economic Policy Uncertainty, or EPU index, which tracks text-based media reporting on domestic policy debates. We contrast this with the Geopolitical Risk, or GPR index, an algorithmic measure of international cross-border tensions, terrorism, and war. The EPU index is discarded in this model. West Texas Intermediate crude is a globally fungible commodity, making localized domestic policy debates irrelevant compared to international kinetic threats. Instead, we isolate the GPR index into two specific subcomponents: GPR threats, representing anticipatory rhetoric, and GPR acts, representing realized kinetic conflict. This chart shows the informational shocks of those indices. The yellow line, representing threats, spikes higher and faster than the red line, representing realized conflict. This exposes a hype gap. The market trades on the fear of rumors far more than reality. This correlation matrix reveals that because threats and acts move together, they create extreme multicollinearity, indicated by the dark red squares. The variance inflation factor, or VIF, measures this correlation. Here, the VIF reaches 27.24, an extreme level that crashes standard models. To accurately forecast modern oil prices, an algorithm must mathematically measure the intensity of international friction before a single barrel of physical oil is disrupted. To survive this severe multicollinearity and navigate regime-switching crises, we developed the Oil Volatility Intelligence Platform, or OVIP. The architecture relies on nonlinear interaction terms. An interaction term is the conditional logic that binds the continuous probability of a market state to an incoming NLP sentiment shock. NLP, or natural language processing, allows the algorithm to comprehend unstructured textual news data. Consider the conditional logic of a calm market. If a negative news headline enters the algorithm, the system routes it through a low crisis probability gate. The output multiplier effectively zeroes out the shock, resulting in a flat, stable volatility forecast. Now apply that same logic to a crisis market. The exact same negative news headline hits a high crisis probability gate. Because the underlying state is fragile, the output multiplier exponentially expands, triggering a massive volatility alarm. We test this architecture strictly out of sample between the years 2021 and 2025 to see what actually drives predictive power in unseen data. This is a chart showing the out-of-sample permutation feature importance. Regime-conditional parameters, such as narrative intensity and compressed uncertainty factors, completely dominate the model's success. Meanwhile, standard autoregressive price returns drop to the very bottom of the impact scale. The mathematics of crowd psychology, global news volume multiplied by textual sentiment inside a crisis regime, is the true predictor of extreme variance. The ultimate litmus test of any financial econometric model is its ability to survive strictly out of sample in violently volatile macroeconomic circumstances. High accuracy on past data is just mathematical curve fitting if it fails in the real world. For corporate risk managers navigating a crisis, exact decimal precision of a volatility forecast is less critical than strict directional accuracy. Knowing the precise timing of an impending upward volatility spike is the single most valuable metric for surviving margin calls and executing dynamic portfolio hedging. Weaponized supply quotas and the extreme speed of algorithmic news distribution have rewritten the rules of commodity pricing forever. Any predictive financial model that relies on historical persistence while ignoring textual sentiment and geopolitical rhetoric inevitably suffers catastrophic out-of-sample failure.